Hey gang, welcome to Time in the Market episode 2, the second episode, and maybe the best episode of the Time in the Market series yet. Today I'm just going to do a quick review of my two portfolios that I talked about the other day, and then I'll do some Excel foo, some exciting Excel action, where I'll show why I invest in stocks and maybe why you should too. So with that in mind, I'll start off with a quick update on how the portfolios are doing. If you remember last week, I think I was somewhere in the 19.5K range with my two portfolios. The first one being this Dividend Aristocrats portfolio, which invests in S&P 500 Dividend Aristocrats, which are stocks that have paid dividends, and not only paid dividends, but also raised dividends for the past 25 years or more. So it's a good group of stocks that I like to invest in simply because they're continually paying dividends through thick and thin, which I think is a good sign of a company that is worth investing in. And historically, these stocks have done well and have beaten the S&P 500. So I thought it made sense to kind of base a portfolio off of this. If you look at how we did in the last week here, the last video was on the 22nd of November. I was at 8,586 there. Now I'm up to $9,000, just north of $9,000. So slightly, maybe around a $400 bump in portfolio value. Some of that is driven by contributions. I did deposit a little bit in there, but some of that is also driven by essentially good results in some of the stocks that I own. In the last week, the stocks are up just north of 1%, which is good to see, and most of that is market gains. Some of that is dividends, which are still very small, but eventually are going to increase as this portfolio grows. If we want to look at how each individual stock did, even though it doesn't really matter, most of the stocks were in the positive, as the whole week was entirely very favorable for the market. So it's good to see, but again, 1 week does not make a trend or anything of that nature, but this is a portfolio that is a very long-term portfolio, and I plan to continue contributing to it for quite some time. So anytime I see growth, I'm happy, but also anytime I see the stock prices fall, I'm also happy because I just plan to keep buying these stocks for as long as possible. And lower prices are better when it comes to long-term dividend payers. And a market like this sometimes isn't great for long-term investing because prices are elevated, and them dropping wouldn't be too terrible when you're in your accumulation phase, as I am, since my portfolio's pretty small right now. 9,000 here, still a lot of room to grow. On the other end of the scale, we've got the industry investments. This is a portfolio I also talked about last week, where I invest in certain industries that I think have good growth potential in the future. And this one is a bit more growth oriented versus dividend oriented, because a lot of these companies are investing their money into growth versus paying out a portion of their earnings as dividends. So potential upside is probably higher than the Dividend Aristocrats. Potential downside is definitely higher because these companies are priced as aggressive growers, and if that growth doesn't materialize, that could be bad for the stocks in question. Again, last time I did this review, I was at 10.8. Now the portfolio sits at 11.3. Again, very good results for this group of stocks. Things like e-commerce, my sports team Slice, and some of these AI and autonomous vehicle stocks did pretty well since the last video, so that's also good to see. It's always nice to see the portfolio go up. And I think this is going to be a common trend since I'm still in the contribution phase with these two portfolios, right? I'm not expecting them to explode. And even if they do explode up or down, it doesn't really matter because the totals are still very small. I'm still young. I'm still in the contribution phase. I don't need this money for a couple of years. So I'm not worried about the prices dropping, and I'm not super excited when they go up in value, even though, obviously that's nice and I'm not going to complain about it. I'm going to keep contributing to these portfolios, and I'm going to be excited to see them grow. I'm going to go to Excel now and kind of give you another view of these two portfolios and where they were on the 22nd, which is when I did my last video, on the 27th, which is when I'm doing this video. I'm doing it on Wednesday before Thanksgiving, just because the market's closed on Thanksgiving and it's only open for half a day on Friday, and I likely won't be home during those days, so it made sense to just get it out of the way and do it earlier to get the video out there this week as well. You can see that last week I was at 19.4K. This week I'm at 20.3K. That's a change of $900. Not too bad for 5 days, three market days. I'm not going to complain about that. I also added a little calculation here. because I know some people like to see this sort of information. I'm not particularly a dividend investor, but the Aristocrats portfolio is a dividend growth investing strategy. So, certainly relevant information to have. My forward income, so this is forward annual income, the dividends that these stocks are going to throw off, went from $300 to $314 this week. So that's nice. It's always nice to see your forward income go up by $14. Since a lot of these companies are growth companies and dividend growing companies, that number is probably going to go up quite often. As I put more money into the stock market, but also as the companies grow their dividends, right? That's the idea behind the Dividend Aristocrats portfolio. That these companies have raised their dividends for 25 years in a row. So I think forward income is cool to see. So pretty good news. That's the portfolio update. If you guys are here for the updates, this is as much as I'm gonna talk about the portfolios, because I wanted to take the time to kind of talk about why I invest in stocks in the first place. And to do that, I kind of want to play around with Excel. And what I have here is the returns for the S&P 500, which is one of the primary index funds that people use to kind of measure stock market returns. It's the 500 biggest companies in the United States by market cap. And I have the returns for the S&P 500 from 1926 until today. So what I wanted to kind of show you is the idea behind stock market investing and why people do it, and why it makes sense to invest in stocks over other things when it comes to building wealth. So the first thing I'll do here is I'll kind of throw a hypothetical at you. Let's say in 1925, at the end of 1925, you said, hey, I want to invest $1,000 in the stock market. What is that going to be worth today? And $1,000 in the stock market in 1926 is something like $14,000 in today's dollars. So it's not an insignificant amount of money, right? So you're talking about quite a bit of money, but it's kind of what I'm doing now, right? I'm investing $20,000 right now and expecting it to grow. So I kind of want to see, if somebody invested a similar amount of money as me in the stock market, what would they have had now if they never used that money? And obviously 1926 to 2018 is almost 100 years. I'm not going to be invested in the stock market for 100 years, but maybe, I'll pass the money on to somebody, some charity, or my children. If I ever have children, I probably won't, but maybe my cousins or something like that, my nephews, will benefit from this money in the future. So, it makes sense to invest for the future. So this $1,000, let me throw some quick formulas in here. Whoops, I want to do this times 100% plus that. Blah, blah, blah. And then let's throw in this formula here and have Excel do its magic right down to the bottom. So essentially, if you invest $1,000 in the stock market and at the end of 1925, you'd have money that starts to grow for you based on the increases of the stock market, the return in the stock market. And this is 1926 through a couple of hard times, right? You went through the Great Depression here. There were a couple of other recessions during these many decades that we're looking at. We went through the 2000 stock market recession. We went through the 2008 crash. And at the end of the day, we end up with $7 million, right? So that's pretty impressive, right? That's clearly illustrating why people are interested in investing, right? And whether it's the stock market or anything that provides some sort of return, investing makes sense because it has the power to turn a small amount of money, $14,000 isn't a small amount of money for some people, but it's still, in relative terms, it's a small amount of money. $1,000 in 1926 dollars turns into, or $14,000 in 1926 dollars rather, in today's dollars, sorry, turns into $7 million. Now that's pretty impressive. If I had the power to turn $1,000 into $7 million, I'd certainly want to take advantage of it. But the problem with that is that it takes quite a bit of time, right? It's 1926 until 2018. We don't have that long period of time. But the idea behind it still works even if the time period is shorter. Because what you can look at is the amount that the stock market has returned annually and kind of transition that into something that makes sense for your own current status, right? If you're 25 years old or you're 30, you're probably investing with a 30 to 40 year time frame. And this can still work well for you. And I'm going to show you what I mean by that. Let's say you're a 25-year-old person, right? You're going to be older in the future, and you're investing for your retirement. And you want to use the power of the stock market to help you do that. You know, you're starting with $0 when you're 25. Let's say you want to invest $5,000 a year. I think that's a reasonable amount of money to invest for someone that's 25. Maybe it's too much, maybe it's too little, but it's just an example. And you want to grow that at a certain number. All right, so for now, we're going to leave it at a 1 there. So I just want to show you what happens to your money if you don't invest it, to kind of give you a comparison. This, and again, I'm going to use some Google magic to make this work a lot faster. Some Google magic, I meant Excel magic to make this go a lot faster. I think this should work if I'm doing it correctly. Yep. So here's a couple of situations for you, right? You're a 25-year-old person. You have the ability to save $5,000, but you're super concerned about losing the money, so you keep it under your mattress. You know, when you turn 65 years old, you've saved $205,000, and your total amount of money that you have at the age of 65 is $205,000 because you kept it under a mattress. You didn't grow any of it. So that's not great. You know, if you're 65 years old and all you have to live on is $205,000 plus Social Security, if that still exists, you're probably not living the lifestyle that you want to live, having saved $5,000 every year. It just doesn't do it for you, right? So if you're saving money at a 0% return, you save $205,000, you end up with $205,000. Not great. Most people don't do that, right? They don't keep their money under a mattress. Some people will still be risk averse, but they're smart enough to know that, hey, maybe I should put my money into a savings account, right? And if I put my money into a savings account right now, if I'm lucky, maybe I'll get 2%, right? A 2% return isn't great. And essentially it's matching inflation, because one thing you have to remember is that $205,000 here, when you're 65, is worth a lot less than it was at 25 because of inflation. You know, your dollar today, or if you have $100 today, it doesn't buy as much as it will when you have $100. Actually, it buys more than it will when you have $100 when you're 65, right? So if you're going to the grocery store with $100 in 2019 and you're 25 years old, you can buy X amount of goods. If you go there when you're 65 in 2059 or whatever it is with $100, you're probably going to be able to buy a lot less, right? So the $205K is not worth as much because of inflation. So you have to save money and grow that money to beat inflation. And a savings account kind of does that, right? It matches inflation. So if you do put your money in a savings account, it grows at 2% a year. You save $205K, you end up with $319,000. You know, not bad. Certainly has some growth at 2%, right? At 0%, you grew $0. At 2%, your savings almost doubled, right? It not doubled, it grew at 50%, right? So you saved $114K. That's pretty good. Still not great though. I mean, if you're retiring with $319,000 in the bank when you're 65, probably not enough money to live on, right? You probably want to save more aggressively and or save in something that's going to provide a higher end total, right? So there's other options. You know, there's bonds. Bonds are, you know, either government issued or company issued debt that you're buying and getting some sort of yield for. Historically, that yield has been in the 4 to 5% range, depending on what kind of bond you buy. These days, it's probably lower, so I'm being very optimistic here that I'm going to get 4% on a bond fund. If you do that, save the same $205K, you end up at $519,098. Not terrible. Still not great though. I think I want more money than $519,000 when I retire. You know, growth again. You've more than doubled your money. You invested $205,000. You ended up with $314,000 in growth for a total of $519,000. So that's pretty good. You can kind of see where this is going. The higher this number, the bigger the impact of growth is. And you can kind of see where I'm going with that. Because if you're saving at 4% with bonds and you're not getting enough money, you want to look for something that's going to give you a higher return. And that something is stocks. And that is one of the main reasons that people invest in stocks, right? The stock market since 1926 has returned almost 10%. And I think that's a very optimistic view because you can look at different time periods and get a different number. Like let's say we look at the return since 1990, which is a more modern time period, right? So that'd be 31 minus 31 here has returned 9.29. There are time periods that are much lower than that. Like for example, if you were to buy from 1999 onwards, your return would be like 4% because that was a bad time to buy stocks. Essentially, everything was super priced, super overpriced. The tech stocks were ridiculously priced with super high valuations, and the returns from that time period weren't great. So that's barely a 5% return. And it's possible that that's what the stock market returns going forward. Probably unlikely because the valuations are still much more reasonable than they were in 1999. But if you look at 2008, there's also different time periods that you can look at where the returns were higher. Right, 2008 was probably, as silly as it sounds, because the stocks were crashing in that time, probably one of the best times to buy because since then things have returned 13%. But realistically, whether you look at whatever time period you look at, people estimate that you can probably get like 7% going forward from the stock market, right? And you may say, well, 4% and 7%, is that really that big of a difference? And yes, it is. Like if you look at a 7% return, it takes your 205,000, right? And it supercharges it from a 519K total to a 1.14 million total, right? That's a 943K growth over that time period if the return is 7%. If we get lucky with a market and it's close to that 9% we've gotten, suddenly you're sitting at 2.01 million, right? So at 9%, oops, and I didn't hard code that, so apologies there. At 9%, you're sitting at $205 invested, same thing, but your total at the end of the period when you're 65 is 2 million. So your growth has just exploded. It's a 2% change in compound growth rate, but you've almost doubled your growth. And that's why people are so interested in investing in stocks, because honestly, stocks are the easiest way to generate a compound growth rate, which is what this is. And I'll explain what I mean by compound growth rate. That's higher than a savings account or a bond fund or something like that, right? If you can get a 7% return on something and get it consistently for a long period of time, you're going to do very well. Even investing as little as $5,000 a year for 40 years will mean you will retire with anywhere between $1 to $2 million, depending on how the stock market does in that time frame. And again, there's no guarantees. Historically, the stock market has returned 7 to 10%. It may return more, it may return less. But the reality is, if you are in a situation where you're starting at zero, which a lot of us are, and I was, right, when I was young, when I came here from Poland as a first-generation immigrant, my parents didn't have any money. So if I don't have wealth that I can build off of, I have to look for something that's going to allow my small amount of money to grow across the years. And the easiest way to do that is to invest in stocks. There are other ways to generate high returns. Real estate exists, but a lot of that, starting a business exists, stuff like that is an option, but a lot of that requires a lot of work. Whereas with stocks, you can just buy a simple S&P 500 index fund from like Vanguard and just put $5,000 into it every year. And miraculously, 40 years later, you're going to have a decent amount of money. Now, again, no guarantees, but there's no guarantees with anything, right? If you want to have a shot at having some money when you're ready to retire, if you want to have a shot at building wealth, what you have to do is invest your money in something that generates a good return. And I'm going to talk about a return, and I'm going to illustrate what a high return does for you versus a low return. So let's go back to the 4% bond return rate, right? When you're 25, the 4% bond gives you $200 in growth, right? Because your starting position is low. When you're 35, oops, let's different calculation here. When you're 35 at a 4% rate of growth, your bond fund that's yielding 4% again generates $2,600 in growth. So that's, you're adding $5,000 in contributions and you're getting $2,600 in growth. And the reason you're getting more growth than in year one, because now your growth is compounding across the years. So initially your growth was based on 4% off of 5,000, which yields 5,200. Next year, you start with 5,200, so you get growth off of that. So growth on a higher number, add 5,000 to that, and that compounds across the years. So you're growing off of a higher number, right? Which is the compounding effect of growth and how people build wealth across the years. When you're 45, that growth is 6,300. When you're 55, that growth is 11,000. When you're 65, that growth is 19,000. You can kind of see the more money you have, the more that growth is impacting your actual portfolio increases, right? When you're young and when your money is close to zero, your growth is a small percentage of your contributions, right? Your contributions make up the majority of your growth, even until your 40s at this low increase. By the time you're 45, though, you're contributing 5,000 a year, but you're seeing growth that's eclipsing that. By the time you're 55, you're seeing growth that's double that. By the time you're 65, you're seeing growth that's almost quadruple that, right? So that's compound growth for you, right? And that's why people say, hey, the first 100,000 is the hardest. And it's true, because if you're investing at a 4% rate, it takes you 13 years, 14 years almost. It takes you from 25 to 39 to hit 100,000. So 14 years. And then from there, it takes you 10 years to hit the next 100,000. After that, it takes you 7 years to hit the next 100,000, and so on and so forth, right? And that's at 4%. So now let's go back and see what that does when you're increasing the growth rate that you're getting, and why people are so concerned about their growth rates. Because if you go to 7%, right, your first year, not that different, right? $350 versus $200 at 4%. But suddenly, when you're 35, you're eclipsing the growth rate. Your growth rate eclipses your contribution by the time you're 35. Now suddenly you're making $5,000 a year in growth. That's more than your contributions. And you're hitting 100K, 12 years in or 13 years in instead of 14 or 15 years in, right? So you're really shortening the timeline it takes to get you to a certain dollar amount, but you're also increasing the growth you're getting from the money that you put into the market, right? And it makes sense. The higher the rate, the higher the growth is going to be, right? So here you're double what the bond is yielding by 35. Here you're almost triple what the bond is yielding by 45. Here you're more than triple. 35,000 is a significant amount of money by the time you're 55. Your portfolio is generating a decent income on its own there. If the rate of return is still 7%, by the time you're 65, that's 75,000 a year is probably enough for two people to live on, if you can depend on a 7% return. And again, this is a very simplified method of looking at it because it's 7% every year. The stock market does not work like that. You can kind of see here, in 94 it was 1%. There's periods of good where the return is very favorable. There's periods of bad where the return is very unfavorable, right? But over the long run, that 7% will be realized, right? So you'll have years that are down, you'll have years that are up. As long as you're buying during the down years and buying during the up years, you're going to do fine, right? That's the idea behind the stock market. And that's what makes this 7% or 9% or whatever hard to achieve, right? People sometimes don't have the stomach to stick in the market that long. And that's why you often see studies that people don't beat the market when they do their own individual trading. And a lot of that is because they sell at the worst time, right? In 2008, when people were selling because the stock market was dropping 37%, they could have been buying and getting a 13% return on their money. That's huge, right? That's the best return you could have gotten in like the last 30 years. That was the best time to buy stocks. When things are bad in the stock market, that's when you should be buying. Right? But oftentimes people go the opposite direction. There's the fight or flight response, right? And it's human nature, right? If your stock suddenly drops, 38%, you're not going to be like, oh, that's fantastic. My $1 million is now worth 600,000. Oh, great. Let me buy more. And yes, it sucks. But if you're young and you're contributing every year, that's the best thing that can happen for you. It's terrible if you're old and your money is suddenly shrinking in half. But if you're older, then you shouldn't be fully invested in the stock market in the first place, right? You should be kind of managing your risk in a way where if the stock market does drop, your entire portfolio isn't sunk and you're not forced to sell at a bad time, right? You have bonds that provide a smaller return and minimize the return you're going to get on your overall portfolio, but they minimize the risk you're going to take and the losses you're going to endure and make you less likely to sell, right? So this, the 7% number, again, if it goes to 9%, if we're lucky enough to get 9%, you can kind of see the magic that happens with a huge return, right? By the time you're 55, you're generating $67K in growth versus $5,000 in contributions, right? And this number just gets astronomical. If let's say you invest $10,000 and you get a 9% return, right? You end up at $4 million when you're 65, right? Your growth that year is like in the top 1% of income earners, and that's why it's that's why rich people stay rich, right? They have this baseline of money, and their growth eclipses what most of us can earn any given year, right? Most of our salaries, my salary is under 100K, right? And if you have $4 million in the market and you're getting a 9% return, or even if you're even if you're invested in bonds, you're still getting a 40K return invested in bonds at $1 million, right? If you have $4 million in the market, getting 4% off of that, you're getting $161,000 in growth, right? And that's the magic of investing, right? That's why investing works for people as long as they stick with it, because the initial phase isn't that impressive, right? The first year, even at a 9% increase, if you're getting a 9% increase, it's $900. For most people, that's like, whatever, $900, great. But what really makes this work is that in the long run, the amount of growth you start getting just compounds on itself. So it's $1,800, right? That's more than double 900, because now your growth is $900 higher than last year, right? You're growing that $900 in addition to the $10,000 you're adding. The year after, it's more than triple, 3.2, 4.5. 5.9, and that continues onwards and onwards and onwards, because each additional dollar you grow is grown next year at that 9%. And that's why people are so starved for growth. And that's why people like Warren Buffett are so amazing, right? If you have somebody like Warren Buffett who at one time returned like 20% for like 40 straight years with Berkshire and Hathaway, or even 50 straight years, you can take that and, at 9%, you're at 4 million. At a 20% return, you're in the billions, right? That's ridiculous, right? The amount of money that is generated by any growth rates above the market is just insane, because you're compounding on a much higher number every single year. And none of us are really going to reach 20%. It's very, very unreasonable that we will. But even something like 7%, that's enough. And that's what the stock market can offer you, right? And that's why I invest in the stock market, and that's why I think a lot of people should invest in the stock market, because it's really the easiest way to build wealth when you're starting at zero, right? And not all of us have $10,000 to invest every year, but even if you have $500 or $1,000 or $2,000 or whatever, right? This is a good spot to get started, because the reality is these first couple of years are very important in investing, because compounding takes a long time to happen, right? If I start at zero at 25, invest $10,000 a year, every year at 7%, I'll end up at 2.2 million, having invested $410,000, right? Now, if I start at 35, invest 20K, I'd have invested almost double the money and end up with a total that's less, right? Because the reality is that the biggest gains are towards the end of this period. biggest gains are in the last 10, 20 years of your long-term investing period, right? So you want to start as early as possible. If you're 25, 20, 21, if you have a job, go to Vanguard, start a Roth IRA, put some money into the stock market. Hope you get a 7% return. As you get older, these losses have to be accounted for. If your portfolio is at $1 million and you think a 30% or a 40% market drop is going to make you sell at the worst time possible, and remember 2008 was a great time to buy, you should start putting your money into bonds. And even when you're young, I think bonds make sense because I have bonds right now. I'm 35. My bond allocation is about 10%. It's not a lot, but it does help you weather some downturns. It does help you allocate money into stocks when they do poorly from another source, and it helps you take money out of stocks when they do well into another source that might not be doing as well, right? That's called rebalancing. These two portfolios, my Dividend Aristocrats portfolio and this Industry Bets portfolio, are all stocks. So there's no bonds in here, because I'm essentially, with these two portfolios, I'm looking for a high rate of return, hopefully something that's above the long-term averages of the market, but you never know. But the majority of my money is in things that will get the long-term averages of the market, and the majority of your money should be too. You should be in S&P 500 index funds, bond funds if you want to manage your risk more. Other things exist, but the reality is that if you want to grow your wealth one way or another, you have to invest in stocks, right? It's the easiest way to do that, and the math shows you why that is, right? If you invest, the current maximum for a 401k, which is a tax-advantaged account that I think everybody should take advantage of. Tax-advantaged accounts are amazing because you don't have to pay taxes on gains or dividends. If you max out your 401k at 25, and if you're lucky enough to do that, that takes quite a bit of money. But let's say you do that when you're 25, or you work up to it when you're 25, and that doesn't even include your employer contributions that are matching. You'll start at zero at 25, and with a 7% return, a reasonable stock return, you're going to end up at $4.2 million, right? That's nice. That's a good amount of money, right? That's why people invest in stocks, right? Because they can take something that starts at nothing and make it into something incredibly large, right? And that's the beauty of stocks, and that's why I invest in stocks, and that's kind of why this journey makes sense to me, right? If I have excess money, does it make sense to put it into a savings account? And there's certainly uses for money in a savings account, right? If you need money within the next couple of years, keep it in a savings account, because stock market prices can drop at the snap of a finger, right? If I'm going to buy a house in the next 2 years, I'm going to keep that in the savings account. If I'm going to buy a car in the next 3 years, if I have some expense that I'm going to need in the next couple of years, it should be in a savings account or a short-term bond. It should not be in the stock market. But if you're aiming for retirement 30, 20, 40, whatever years from now, that money should be in stocks, right? Because if the stock market tomorrow drops 37% like it did in 2008, if there's 3 consecutive years of negative returns like there were in 2000, 2011, 2001, and 2002, it doesn't really matter to me, right? Because I'm 35. If my stocks drop 40% tomorrow, I'm going to buy more, because that's probably the best time to buy. And if I want to hit that 7% average, right, I have to buy when times are good and when times are bad. And that's what you want to do, right? You want to put money in the market like Ron Popeil and the Ronco rotisserie. You want to set it and forget it, right? And the stock market allows you to do that, right? When you're investing in real estate or you're doing something else, starting a business, there's a lot of work to that. And I don't know about you, but I'm kind of lazy. I don't want to do it. What I want to do is I want to put my money in the market. I want to keep putting my money in the market. I want to set it. I want to forget it. And 20 years later or 30 years later, I want to look at that money and say, hey, there's a decent amount in here. I've built wealth, right? Because investing in the stock market and owning these companies, because that's what you're doing, you're owning these companies, is a good way to build wealth. And it's open to anybody. You can start at zero. You can come from Poland with no money, with parents who have had no education. You can read books, you can learn about it, you can do just as well as any professionals. And when you're 55, when you're 65, you can have a couple $1 million. $1 million, $2 million, $3 million. That's the beauty of the stock market. That's why I invest in it. And I think that's why people should invest in the stock market too. So hopefully that was a good reason for you to invest in the stock market. If you haven't, if you do, then it probably gives you more clarity as to why you're investing. But also it's, it's just interesting to look at the numbers and see exactly how impressive the growth can be when you look at it from a long-term perspective. Because like I said, the first couple of years, not that impressive. The first $100,000 is definitely the hardest. The second $100,000 is the second hardest. Once you sort of start breaking through that line, right now we're sitting at $20,000. Even if my portfolio were to return 50%, right, it'd be 10 grand. Great return, can't keep it up forever, but $10,000 is not going to change my life. But 10 years from now, when this portfolio is $200,000, $300,000, $500,000, I could get a standard market return of 7-8% and get $30,000 to $40,000 from that, right? And part of that will be growth, part of that will be dividends. But the important thing is that if you want to hit the 7% return mark, you got to stick with it. It's a long-term play. You're not buying and selling every day, incurring tax, paying taxes, buying at a bad time, or buying at a good time, or selling at a bad time, selling at a good time. Who knows? You got to put your money in the market, stick with it, put it in an index fund. If you want to pick some stocks, do a lot of research, talk to professionals, right? I as always, I'm not a licensed investment advisor. What I'm doing here is just for fun. I'm just trying to illustrate the value of the stock market and show you why I invest in it. And hopefully, this was educational to some. I had a lot of fun kind of going through the numbers. I was actually kind of impressed as to how much you can make if you're 25 and you have the ability to max out your 401k and want to retire at a standard time frame. You invest $758,000, you end up with more than $4 million. That's pretty nice. And I don't know about you, but $4 million when I'm 65 sounds pretty great. So that's it for today's episode. I'll be back next week with another portfolio update and some more information for you guys. If you have any questions, leave them in the comments. If you like the episode or have any criticism, good or bad, I'm starting a new series here, so who knows what people think about it. I'd love to hear it. If you want to send me an email, I think there's probably a link somewhere where you can contact me, but maybe I'll add that to the show notes, and also I'll sort of throw in all the links that I talked about. I'll share my portfolio for M1 Finance and my link to M1 Finance if anybody wants to sign up. But again, M1 Finance is just one of many portfolio brokers out there. If you want something simple, Vanguard, Fidelity, Schwab, TD Ameritrade, all of those guys are great. All of those guys work. All of those guys, for the most part, now have free trades, which is awesome. I just like M1 Finance for the fact that I can buy like a ton of stocks without a ton of capital. So it allows me to build a portfolio that's very diversified without having to buy, without having to start with a ton of money, right? And like many of you, I'm starting at zero. I'm hoping to get, maybe not to 4 million, but something pretty high, and hopefully I can do that, and some of you can join me along the way. So again, thanks for watching. Hope you have a good Thanksgiving. Hope you had a good Thanksgiving. If I upload this after Wednesday, and have a good day, everybody. Have a good week.